Hello everybody, I'm Sony Mathews, Senior Market Strategist for Geojit Financial Services, and with me on this discussion we have Dr. Vijayakumar, Chief Investment Strategist for Geojit. So welcome to this discussion, I should say. 2019 has been a very eventful year for the stock markets. It started out slow, came down with the Modi 2.0 budget, and then ended with a bang, at least for the benchmark indices, the Nifty and the Sensex. But then when you look at it, this rally has been driven by just a handful of stocks. Money was chasing high quality stocks, it was chasing stability and earnings visibility. The uncertainty that was on everybody's mind was with regards to the economic slowdown that India was facing. The latest GDP numbers came in at 4.5% GDP growth. The corporate earnings were also not recovering. So this could be the theme, that could run the 2020 stock market show. Whether the Indian stock markets will recover, whether the global economy will also support the huge FII inflows that we received in 2019. So I would like your opinions also on how the global economy and the Indian economy will fare in 2020, because I think that will have a bearing on how the stock markets will also perform. So what are your opinions on that, sir?
Well, the new year started off on a very optimistic, promising note. Last year, a major concern in the markets globally was the trade dispute between US and China. There was a concern that this trade dispute can exaggerate, can explode into a full-blown trade war. And if that happens, there was a distinct possibility that 2020 will witness a global recession. Now that fear is no longer there. The fear of a global recession in 2020 has completely receded. The data from US is very good, and they are going to sign the first phase of the US-China agreement on the 15th of January. Even though it is not a substantive agreement, it is certainly a very good.
Basically.
Yes, it is indeed a very good beginning. Then Eurozone is likely to perform well this year because with Boris Johnson emerging very powerful after the elections, a Brexit with a deal is very much on the cards. Therefore, Eurozone will do well. Japan is slowly recovering. So global economy, actually the prospects looked very, very good at the beginning of the year, but then suddenly things have taken a turn for the worse in the Middle East. And consequently, crude prices have risen by around 5%. That is not good news for an economy like India. So it remains, these are early days about this problem in the Middle East, early days. We don't know how it will evolve. But generally, for the economy as a whole, things are looking better. Coming specifically to India, our GDP growth this year, 2019-20, we are likely to end with a GDP growth rate of around 5%. Right. That's a 6-year low, but the prospects for next year are bright. We expect the economy to recover. It won't be a very sharp recovery, but certainly there will be a recovery starting with the first quarter of financial year 21. So the coming year, we are likely to witness a 6% GDP growth. And thanks to the corporate tax cuts, corporate earnings will be in, let us say, north of 15%. Right. So this is the economic and market scenario, economic and corporate earning scenario. In such a scenario, what is the strategy, investment strategy that we are recommending to our clients?
Right. So as we spoke about earlier, this market rally was driven by a few stocks, especially in the consumption sector where we saw the
10
valuation.
to 15 stocks.
Yeah. So these 10 to 15 stocks have already gone up in terms of their valuation. So we might not see huge growth. Of course, these are all good stocks, quality stocks, but then the rate of return that we can expect from these stocks would be in the single digits, in the lower return. So our focus, Geojit Research, we are now informing our customers to focus on the cyclical sectors which can recover along with the economy recovering in the first quarter of FY21, especially the banking sector, focusing on the private banks as well as the small rural banks that are there, the chemical sector, the metal sector. So these are all the sectors that can show or that can provide good returns in 2020. Also, small and mid cap stocks have shown a huge divergence, when you compare it with their large cap valuations, and that is close to multi-year highs, the divergence. So this polarized valuation, would it be a good time to actually start off your investments in mid and small caps, considering the valuation difference that is there between large caps and mid caps? Would this be a good time to start off our investments in mid and small caps?
Yes, certainly. This highly polarized valuations is the unique characteristic of the rally that we are witnessing now. We never had such polarized valuations. This point we discussed earlier also in the Nifty 50. 15 stocks, if you take the last 2 years, have delivered 40% returns, but the other 35 has delivered a negative 19% returns. And this kind of polarized valuations are not likely to sustain. As you said, among this Nifty 15 stocks are large cap quality private sector banks, which are likely to report again 20% or more earnings growth. So there the high valuations can be justified. It can again expand a little bit in tune with the earnings growth that they report. But there are consumption stocks where the growth is only 10%, but the PE ratio is 55, 60, 65. If these stocks again rise in valuations, they will be moving into bubble territory with inevitable consequences. So we actually now see an opportunity for contra investing in 2020 because some of these sectors which did not participate in the rally in 2019 are likely to participate in 2020. Automobiles, for instance. Well, the earnings visibility is not there, right? If there is earnings visibility, the valuations would have run up. There is no earnings visibility, but then before the earnings visibility emerges, stock prices will go up. So there are contrarian investment opportunities in autos, in capital goods. Already a huge investment in infrastructure has been announced by the government. If we are to reach a $5 trillion economy, massive investment is required. So infrastructure, capital goods, cement and metals are some sectors which are likely to witness catching up in valuations.
We are seeing little bit of growth.
Yes, it has already started.
Some movements in these sectors already.
Some movements have already started, and this movement is likely to gather momentum going forward. So that is a major opportunity. Yes.
Now, also, in addition to the equity investments, considering the volatility that we are seeing right now, what would be your opinion on the fixed income investments, the fixed income space? What is your opinion on that?
Well, frankly, fixed income investment gave very disappointing returns last year because of the issues that we had in the NBFC
governance
segment. Governance issues, some large NBFCs defaulting.
So that has actually, the trust of investors have also been lost, because it was considered more or less a safe investment when it comes to fixed income.
Yes, a trust has been impacted. What can you do when a AAA rated bond suddenly falls from AAA to D in a matter of 2 months? Nobody could anticipate that, right? So that was one of the reasons why fixed income returns disappointed last year. But that is behind us. That problem is behind us. All the provisioning has been done, side pocketing, all those things have been done. So there is opportunity for debt investments in 2020. We must always remember that we are in a low interest regime as far as bank deposits are concerned. You get 6.75% for a fixed deposit. So if you are in the 30% tax bracket, your real return will be, net return will be less than 5%.
Less than 5%.
So if you factor in inflation, the return will be almost zero. So because of the superior tax efficiency of debt investment, inflation indexing and all that, lower tax, that always is attractive. So investors should also look at other investment opportunities. There are attractive investment opportunities elsewhere. For example, public provident fund, it gives 7.9% returns. 5-year national savings certificates, 7.9% returns. Post Office Senior Citizens Savings Scheme, 8.6% returns. These are fixed income opportunities which investors should look at very seriously.
Tax efficient also.
It is highly tax efficient, tax efficient. Therefore, the net returns post-tax will be very, very attractive. And now, presently, we are living at a time when unexpected things are happening and risk is high. Therefore, gold has shot through the roof. It is quoting at a record high. So, what is the investment strategy on gold that we are recommending right now?
So, gold is always a safe haven asset, when it shines brighter, when there are uncertainties all around. And with the Middle East tensions going on right now, as we speak, gold is at record highs. It is a pure play diversification product. We wouldn't advise, going all out investment into gold.
5 to 10%.
5 to 10% maximum. And the best way to invest, rather than buying physical gold, it would be better if you invest through sovereign gold bonds, because it tracks the price of gold, plus you get a 2.5% interest also on these bonds. Or you could look at gold ETFs, which provides us easy liquidity, tracks the price of gold, you don't have to pay any other extra charges. So these two methods are suggested for investments into gold. Regarding the gold prices, yes, we definitely, with the heightened tensions, we expect at least in the near term for gold prices to remain high. Plus the oil prices have also shot up, which will put pressure on the Indian rupee, which will again support the gold prices. So any investor looking to invest in gold can either look at gold ETFs or sovereign gold bonds. So we are looking at a volatile start to the year 2020 with the Middle East tensions. What should investors look out for? On a closing note, what should they look out for? What are the threats that can emerge? What are the challenges that they may face in 2020?
Well, 2020, like all years, are unpredictable.
Yes.
All recent years have been unpredictable. A very important point that I would like to stress here is, during the last 3 years, markets have been moving in tandem. You have either a synchronized rally or a synchronized downturn. For example, in 2017, we had a global stock market rally. In 2018, it was a downtrend, again synchronized downtrend. In 2019, again, in spite of poor economic performance, global stock market rally, right?
Liquidity was
because of the liquidity factor, yes. Because we are still being driven, markets are still being driven by the humongous liquidity that was created post the 2008 crisis. So, capital inflows and outflows will be global, and it will be determined by large number of other factors. So 2020 we have to watch for global events. One risk is globally there is no valuation comfort in the market. Valuations are high because of the last year's rally. Valuations are high, and when valuations are high, margin of safety is low, and if there is some global trigger, some black swan event, some event which can't be anticipated right now happens, it can impact the market. That is the risk. But then such risk will always be in the market. Such risk will always be there. So investors are generally optimistic. We are investing because we hope that tomorrow will be better than today, right?
Expectations.
Yes, expectations and hope. That's why all investors are optimists, not pessimists. Pessimists never invest. So we should be optimistic about the prospects for 2020. Certainly, if I summarize, I will put it this way. Global economy, barring unforeseen circumstances, will do better than in 2019. Indian economy, the next financial year, will do better than 2019-20. Corporate earnings next year will be better than corporate earnings this year and the last year. Interest rates will continue to remain low. More money will continue to come to the market. In such a scenario, markets have the potential to go up. But then the rally will not be in the large cap blue chips alone. The rally is likely to spread to mid and small caps, quality mid caps mainly, and also in large caps where the valuations are very attractive. So we can expect a broadening of the rally
Right.
in the coming year.
Right.
And not the coming year, the 2020, we can expect a broadening of rally.
Thank you, and wishing all our investors a very prosperous new year.